Let's also get a move on and connect with Aniruddha Sarkar. He's a CIO and Portfolio Manager at Quest Investment Advisors to talk a little bit more about the sectors in focus and the value versus growth debate. Aniruddha, great to have you on board. Many thanks for joining in. To begin with, just let's get in a sense as to what your investment outlook and portfolio strategy is in terms of the value versus growth argument. I believe that the aim is to balance the two.
Yeah, hi, Avan. So I think, one thing which I've been trying to focus on is trying to balance the value and the growth part of the market. The way the markets have moved, I think, to be honest, it's become very difficult to find any good investment ideas. So what I've been trying to look for is the earnings growth within the value part of the market, because that is where the whole P multiple expansion happens. And that has been my focus area over the years. I'm not in that camp, who will be paying any price for earnings, and would like to keep an eye on the valuation, because for me, the margin of safety is very, very important. So that's the reason, actually you will find that I don't own any of the consumer names in my portfolio. One thing which I've been trying to focus on for the last 6 to 8 months, which I've been trying to communicate with my investors also, is that the cyclical side of the market is seeing an earnings revival after a very, very long time. And catching them early on is basically the key to ride the cycle. We have been adding some of the cyclicals in our portfolio because that is where we believe there's a decent amount of value which is there. And after almost 6-8 years of seeing the weakness, we are seeing the earnings revival picking up over there. I believe that there's enough headroom actually for the cyclicals to kind of give you decent alpha from here, because the capex cycle has basically just picked up in India. So not just in India, if I have to just see, even in the rest of the world, I think the capex cycle is something which has just begun, and we would see a decent kind of an uptick on that. Now, one thing which has become very, very important for me is to try to look for the growth in the earnings within the value part of the market, within the small and mid cap piece of the market. Because my personal belief is the mid and small cap part of the market is actually now coming out of the woods after almost 4-5 years. And if an investor has an horizon of next 4 to 5 years, I think the mid and small cap is going to see a massive, massive earnings uptick. And a large part of that market is still very, very attractively priced. I keep giving examples of companies, which are quoting at 1 time or much less than 1 time on the PEG ratio, which gives me the comfort that, you're not paying a high price for the earnings which is going to come in. And the basic thing of the value and the growth part is that we are seeing a large part of the whole unorganized market also shifting to the organized market. And that's the reason many of the value companies, wherein, they have been kind of, underperforming for a long period of time, are seeing a major earnings uptick over there.
All right. Now, in terms of the overall valuation picture, what is your advice to investors, particularly looking at companies within the broader markets?
Now, one thing which is kind of, as I mentioned, is trying to look for the earnings growth. And one thing we have been highlighting in our portfolio construct and also in our communication with investors is that sector rotation has to be the key focus area. And that has been kind of my companion over the last 6 to 7 years, wherein that, sector rotation, trying to look at where the earnings upcycle is happening. And that is where investors also need to focus on. If you ask me where investors should be looking at this point of time, I think sectors like the pharma is one space which, we have been bullish on for the last 8 to 10 months. And I believe the Indian API industry is actually increasingly playing a bigger role in the whole supply chain in the world. And I think that is one space investors need to continue to focus on. Indian pharma companies, from being just the pharmacy to the US, have now become the pharmacy to the world. And I think that's a large story which is going to unfold. The chemicals and specialty chemicals industry is another industry where I believe the Y2K moment has come. And to be honest, if just 8 to 10% of the Chinese volumes need to ship to India, that would be like a 100% incremental gain for the Indian chemical industry. So that is another interesting space wherein, investors should be looking at. IT industry is one space, where we have been bullish for the last 1 year. And I think that's a story which is going to play out over the next 18 to 24 months, because the whole IT industry has gone through a structural up move. And if you look at the companies across the globe, they have increased their IT budgets significantly. And that is leading to large deals for most of the Indian IT companies. If you look at the large cap, mid cap, or small cap IT companies, I think the deal wins have been exceptionally well. And I think that is something which will continue to add on their earnings growth. One interesting space, which I would say is a slightly contrarian call, and, very few would be actually looking at, is the whole the home improvement space, which includes exposure of companies which are there in the real estate. Because after almost 7 to 8 years, we have seen the real estate market picking up. And the interesting part of the market in this upcycle is that the last upcycle was dominated by investors buying the properties. But this time we are seeing the end users buying the properties. Now, the big difference of that too is that, when the end users are buying properties, a large amount of investment happens in making up the interiors. So the home improvement space, which includes the plywood companies, the electric cables, appliances, that is one interesting space which we have been very bullish on, and we continue to build our exposure over there. And I think that is again one space where investors can focus on. So lastly, one sector which is kind of, I would say it's not the hot favorite, but a sector which is the old economy sector, which is the power and the utility sector, is again one space where investors can have a look, because we have been building a position in that space in the last couple of months. And I believe an issue which was hurting that sector was the high leverage on its books. And that is something which is now decreasing substantially. And with the leverage coming off drastically, I think there's going to be a multiple expansion happening in that space. Also, you have companies in that space who are building up the whole EV charging ecosystem. There are companies who have a large portfolio of the solar energy. And these are some things which will definitely get a much higher multiple compared to what they used to get in the past. So these are some of the sectors which I would believe, investors should focus on. Some sectors which have been underweight on, and I continue to be underweight on, is one is I would say the banking and the financials. Within the banking and financials, I would say it's a bit of a difficult call, because with index having a large allocation to the financials and you underweight financials is like a difficult call. But I would say within the financial, there are enough ideas which are on the cyclical side of the financials, where the NPA provisions have been high in the past. And now those provisions, recoveries are happening. And that is a big play which is going to unfold. And the valuation is on your side. Whether we're talking about the large PSU banks or some of the private large commercial banks, I think, valuation is on your side. NPA recoveries are on the rise. And I think, that is one space you can participate, keeping your overall financial exposure low.
Right. Aniruddha, you've often talked about as to how that you're not willing to pay just any price for growth, and you're going to be careful. But how is it that you apply this rule in a market like right now, wherein growth and growth is one part of the story, but none of the valuation or pricing multiples justify the kind of, levels that we're currently sitting at? I mean, those principles are not really applicable. Just everything is expensive.
I would say that, there are enough ideas. Like, if I have to give you, I'll not mention the names, but, in sectors like the specialty chemical sector, even for the home improvement space, there are companies who have been getting those single-digit P multiples historically. Now, these were the companies who were getting those single-digit P multiples because their whole earnings profile was considered to be the commodity business. Now, what has changed in the last 2-3 years is that the whole, the basket of the offering of these companies has changed, wherein the margins which they used to enjoy earlier, they are now making much higher the EBITDA margins. Now, that margin improvement, you cannot call these companies still a commodity company and give them that same single-digit P multiples. The other thing which has changed is that the ROEs have improved drastically. The high leverage on their books, which was there, which was to again be one of the reasons for these companies to get a low multiple, they have gone down drastically. We have some companies in the portfolio that the debt equity has gone down from 1.8 to as low as 0.4 in the last 18 months. So there has been a massive improvement on the balance sheet, massive improvement on the whole margin improvement, massive improvement on the earnings profile, and also they have entered the new products in the new markets. Now, all these things calls for a multiple expansion. Some part of that has happened, but I believe that if one is looking at the next 12, 18, 24 months, there's going to be a massive multiple expansion for these companies. There are some companies in the home improvement space who are into, the PVC pipe business, but that is like, a 10, 15, 20% of their business. And the multiples they get for that part of the business is a fraction of what a pure PVC business gets. So I think there's a huge multiple expansion which can happen.
Okay. All right. Thanks much for taking time out. We'll let you go on that note.